implications of the conflict are of course huge. Beyond the human toll, the conflict has disrupted the Middle East's increasingly diversified economies. Air transport and tourism are affected in a major way, so are of course the important oil and gas flows. Restricted supplies will hit importers, whereas the higher prices will impact all consumers. Whatever trade can flow in and out of the Gulf will have to find new routes. Some maritime shippers are even avoiding the Suez Canal, adding costs and time to shipments to and from the rest of the world. Overall, we are at risk of entering a period of stagflation. Somewhat understandably, many investors push the sell button, especially for investments where they could realize gains, such as equities and gold. The US dollar is one of the few assets which has benefited so far. Oil and increasingly gas are globally traded commodities. Any major supply disruption has an immediate impact on prices. The Middle East sits at the heart of the global energy infrastructure. 20% of the global oil supply flows out of the Gulf, as does 20% of global LNG. So we're talking about major losses to global supply. Ahead of the hostilities, global oil markets were well supplied, and OPEC added another 200,000 barrels a day to its output over the weekend. Nevertheless, Middle Eastern energy commodities need to find alternative routes, avoiding the contested Strait of Hormuz to stop prices from rising even more. For crude, some avenues are available. For LNG, this is not the case. One way of plugging the temporary deficits is increased production elsewhere, which could favor American onshore production, and more immediately, a drawdown of reserves. Short term, however, higher prices will prevail. Brent is already trading above $80 per barrel, and depending on how much of the region's oil infrastructure is affected, the upside to both oil and LNG prices can be material. Higher crude prices may, on the other hand, also temper the ambitions of the US president. After all, he is facing midterm elections in November, and the protracted war with sustainably higher oil prices will weigh on the Republican Party's prospect in this electoral campaign. Well, when a war starts, many investors run for the exit. The sell-off in equities and the jump of the US dollar are clearly signs of this. However, as always, we need to look at the wider context and the real risks created by a conflict. Higher inflation and lower growth are one likely outcome, at least near term. For investors, this means to check their own positioning. How exposed are they to a change of the macro backdrop? For example, the current pressures on yields is largely due to inflation. If the war were to continue for some time, most economies would encounter higher consumer prices. Bond markets are already anticipating some of this. Central banks tend to look through external shocks such as spikes of energy prices, but they are mindful of second-round effects. So far, though, we have no indication that policy is set to change in the US or elsewhere. Portfolios need to be able to handle some volatility, and drawdowns are part of the story. But if the context changes, some adjustments may be required. We are convinced that diversification is the best hedge in any circumstances, even if for the time being both bonds and equities are under pressure. Diversification, however, is more than just equities versus bonds. It also includes regional, sector, and currency allocations, which in most well-diversified portfolios will cushion the blow. Moreover, we focus on quality assets as well as gold, which tend to withstand stress better. They will also rebound quickly once the worst of a crisis has passed. At this stage, of course, we do not know how long the conflict will go on, and Europe and parts of Asia appear most exposed right now. It's early days, of course. Any forward-looking statement can only be made with some degree of confidence once the hot part of the conflict has ended. So far, US assets have held up fairly well, suggesting that international investors are not shedding their positions wholesale. However, we would expect mounting concerns about the credibility and reliability of the US, which argues for diversification away from US assets after years of their outperformance. Apart from this, and to add a positive note, changes in Iran and in the relations with Iran could represent a phenomenal economic opportunity for the region. With a well-educated population of 92 million, after years of economic mismanagement, the country will require substantial investments. Finally, the reliance on energy commodities from the Middle East continues to represent a significant vulnerability for many importing countries. Diversifying their energy supply will be a recurring priority. On the flip side, Middle Eastern economies need to cut their reliance on energy exports further and become even more diversified themselves.